Okay, so for video 4, we are looking at the remainder of chapter 10, and we're starting with looking at the natural resources and how to deplete them. So the process is similar to what we do for units of production for plant assets, but now we're going to be looking at natural resources. So we think about what are they? Natural resources are going to be those things that are provided from the earth. So they're provided in nature, and we're going to use the total cost, and we're going to allocate that over the number of units we pull out of there. So we're going to use something called depletion instead of depreciation. When we look at some examples, they give here oil, coal, gold. We could also have like a mineral. We could have silver, anything that comes from the earth. Like trees or timber. Those kind of things can be depleted as well. When we look at what do we include in that cost? Well, it's the total cost of that asset, and then we have to calculate the depletion per unit. Just like when we did units of production, now we're looking at the depletion per unit, and we take that number times how many units were actually pulled out in that period. So here they give us an example that it says a mineral deposit with an estimated 250,000 tons of available ore is purchased for 500,000, and we expect a zero salvage value. So we take our cost, 500,000 minus 0, divided by the 250,000 tons. That gives us $2 per ton that we're going to deplete per unit. During the first year, they have 85,000 units that are extracted. So we take $2 times 85,000, and 170,000 is going to be our depletion expense for that year. So our entry is going to be a debit to depletion expense and a credit to accumulated depletion. We've seen a similar entry before. So the entry looks similar to depreciation. We just have a different word that we use for natural resources, and it's called depletion. So instead of depreciation, we're going to have depletion. On the balance sheet, we're going to see it reported the same as we had our plant assets, where we list the asset minus that accumulated. So in this case, we have the asset mineral deposit minus the accumulated depletion, giving us the book value, or 330,000 of that asset. When we look at what happens if we mine some, but we didn't sell it all, well, in that case, we're going to put it into our inventory. So here we have an example where we had depletion expense, and we depleted some of it because we sold it, but we had $30,000 of ore that we harvested that we did not sell. So in that case, we're going to put it into our inventory as ore inventory, and we're still going to record that total depletion. All right, so sometimes we might have assets that are tied into those natural resources. Like we might need a machine to help us get that natural resource out of the mine. So in that case, we're going to make sure that we account for them separately, because plant assets and natural resources are still accounted for separately. They're stored depreciated and depleted separately. All right, let's look at intangible assets. Remember, those are the things we can't physically touch. Typically, they're giving us some kind of a right or a privilege for their use. It's, depending, some of them have a very clear light, because in the paperwork that you file to get it, it says you have this much time of this. Like, for example, a copyright, you have so much time that you own that copyright. When we think about them, again, they don't have they're not physically able to be touched. There is paperwork that's associated with it, but that's not considered the asset itself. And they're used to, help our operations. When we look at the cost of them, we're going to record them at cost. They're going to include the purchase price, any legal fees, and filing fees. And over to the right, you see some examples of some of those intangibles. They list here patents, copyrights, franchises and licenses, trademarks and trade names, goodwill, lease or right of use assets, leasehold improvements, research and development, and then we can have lots of different ones depending on the industry you're in. But we're going to include that purchase price, the legal fees, and the filing fees in our total cost. All right, when we look at total asset turnover, we're going to be looking at our ratio, and it takes net sales divided by average total assets. Remember, anytime you see that word average, that means you have to add two numbers together and divide by 2. So here we have one for Starbucks and one for Jack in the Box. They have the net sales. That's what we're going to need. And then we also need average total assets. So that's why they list 3 years here, because we need to have the assets from the current year and the previous year to calculate that current year's average total assets. And then we can divide and get the answer. Now, in your problems, it's important to pay attention to, are they giving you the average already, or do they give you the information where you have to calculate that average? So that's what you want to watch for. All right, this concludes our chapter 10. And now just take a look at the comprehensive problem and see what you need to do.